We are standing at a critical juncture in the financial markets, a moment where the illusion of perpetual stability is violently colliding with the harsh reality of global geopolitical tension. As we look ahead to the futures market opening on Sunday night and bleeding into the Monday morning session, we are staring down the barrel of a sharp and immediate shift in market dynamics. Based on the weekend's developments regarding sudden military action, the equity markets are heavily favored to gap sharply lower right out of the gate. My expectation, drawn directly from the structural setup we have been tracking, is an initial opening decline of at least 1%, and very possibly up to 1.5% on the broader indices. This is not a moment for panic, but rather a moment for profound clarity and strategic preparation. If this military engagement were to achieve its objectives instantly and conclude before the Monday bell, we might see a miraculous rebound, but the current reality on the ground suggests that this scenario is highly improbable. Instead, we are entering a phase where the psychological resolve of the everyday investor is going to be tested against the cold, calculated maneuvers of institutional capital. To understand what is happening right now, we have to look past the sensational headlines and focus on the underlying structure of the market, because the structural evidence has been warning us of this exact vulnerability for months. Since the beginning of the year, we have been observing a massive, slow-moving distribution phase. In simple terms, this is a prolonged period where massive institutional funds, the smart money, have been quietly and systematically selling their positions, unloading their heavy inventory into the eager, outstretched hands of retail buyers. These retail investors are purchasing under the dangerous assumption that the market has permanently unlearned how to fall. This brings us to one of the most vital psychological discussions we can have regarding wealth building, the lethal trap of confirmation bias. When the market goes up uninterrupted for an extended period, human psychology begins to project that the recent past infinitely into the future. Retail traders become infected with a sense of invincibility, a blind belief that the market will simply never go down again. But I must emphasize this with absolute clarity. A market can do anything it wants, at any time, and assuming otherwise is the fastest way to destroy your portfolio. The danger of this confirmation bias is only magnified by the noise of the broader financial industry. Right now, we are seeing analysts raising their price targets to absolutely astronomical levels for They are feeding the public ludicrous numbers, projecting endless upward momentum while completely ignoring the structural reality of the present moment. As a professional strategist, I do not deal in hope, and I do not deal in ego. I deal in the cold, hard mathematics of probability and risk versus reward. When you step back and look at the actual architecture of the S&P 500, the upside potential is severely capped by a massive structural ceiling. This upper boundary has acted as an impenetrable barrier, limiting any meaningful upward progress and creating a heavily skewed risk profile. In the absolute best-case bullish scenario, if the market somehow defies gravity and pushes higher, it would slam directly into ultimate upside resistance right around the 7,100 level on the S&P 500. The probability of breaking cleanly through that 7,100 ceiling without a massive fundamental catalyst is remarkably low, which means anyone buying aggressively at these heights is risking a massive fall for a very tiny sliver of potential gain. Instead of gazing at highly unlikely upside targets, our focus must be locked dead center on the critical floor sitting beneath us. Since January, the S&P 500 has established a very clear defining line in the sand, a structural floor resting precisely around the 6,799 level. This 6,799 marker has been the ultimate stopping point for every recent pullback, the absolute threshold where buyers have previously stepped in to save the day. As we move into Monday's deeply contested session, the single most important question in the financial world is whether that 6,799 floor finally fractures. We are watching to see if the market drops, hits that level, and bounces, or if we witness a definitive daily close beneath it, signaling a complete structural breakdown. If that floor at 6,799 gives way, the mathematics of the breakdown project a very specific and immediate downside sequence. We would be looking at a rapid 3% drop measured directly from that breaking point. If we calculate that drop from where the market actually closed on Friday afternoon, it translates into a sudden 4.3% decline as our next near-term target. Now, market mechanics dictate that assets rarely move in straight lines. If we do experience that sharp breakdown below 6,799 and hit that initial target, probability suggests we will see a temporary bounce. There is a significant amount of historical demand clustered in that lower region, and it is entirely natural for the market to catch its breath, rally slightly for a few days or maybe a week, and lure a new batch of overly optimistic buyers back into the trap. But you must maintain your discipline and recognize these short-lived rallies for what they are. Following that temporary bounce, my expectation remains a resumption of the broader descent, carving out the next full leg to the downside. I have remained completely steadfast since the beginning of the year, urging a conservative, protective posture, because my ultimate first-half target for this market correction sits far below current prices, resting heavily at the 6,100 level on the S&P 500. It is only when we reach that 6,100 valuation that the risk-to-reward ratio finally shifts back in favor of the long-term investor. At 6,100, we clear out the excess, we reset the valuations, and we set the stage for a much more sustainable, fundamentally sound bounce that could last for weeks or even months. Until that level is achieved, patience is your greatest weapon. While the equity markets prepare for this gravitational pull, the energy markets are violently exploding in the opposite direction. From its recent lows established on January 7th, oil has already surged an impressive 20%. However, as we head into the Sunday night futures session, the geopolitical friction is acting as a massive accelerant. With military action in play, we are likely looking at another immediate 10% gap up in crude prices. The geographical epicenter of this tension is the Straits of Hormuz, a massive global choke point where roughly 20% of the entire world's oil supply must transit. The mere threat of disruption in that critical waterway forces the market to instantly price in a massive risk premium, sending energy costs soaring. This sudden spike in oil is going to inflict immediate collateral damage on the broader economy by acting as a direct catalyst for higher inflation. However, to truly navigate this market, we must elevate our thinking beyond the immediate panic and analyze the complex political calculus unfolding behind the scenes. This is where market analysis intersects with geopolitical strategy. In my assessment, there is a very deliberate rhyme and reason to the timing of this military action by the current administration. Politically speaking, if a government is going to absorb the inflationary blow of a massive oil spike, it must do it right now, early in the cycle. The strategic objective here appears to be a rapid intervention to remove the current Iranian ruling party and replace it with a government that is far more favorable to Western interests. If this aggressive maneuver is successful, the long-term economic payoff for the administration is massive. A regime change would theoretically lift existing sanctions, allowing Iranian oil to flow freely and abundantly into the global market. If we game out this probability, the administration endures severe but short-lived inflationary pain right now, but by the time we arrive at the highly consequential midterm elections in September, October and November, the macro landscape looks entirely different. The global market becomes flooded with fresh supply. The risk premium evaporates because the Straits of Hormuz are no longer under threat, and oil prices collapse. Under this scenario, we could easily see oil plummet all the way back down to $50 a barrel, just in time for the midterms. That $50 price tag brings massive relief to the gas pump, crushes the inflation narrative, and drastically improves the mood of the heavily short-sighted retail consumer right before they head to the voting booths. The political advisors orchestrating this understand that the modern news cycle is incredibly fast. The public will forget the panic of today if they are experiencing economic relief in the fall. Of course, this entire thesis hinges on the military action being swift and successful. If the ruling party in Iran entrenches itself and retains power, we are looking at an exceptionally bad, prolonged scenario for global energy prices. But assuming the administration's aggressive timeline holds, resolving the conflict in a week or two, the subsequent crash in oil will be far more violent than the current spike. This profound disconnect between the short-term panic spike and the high-probability long-term collapse creates a spectacular opportunity for structured positioning. We are anticipating this overnight gap up to push oil prices straight into a massive structural ceiling, representing heavy upside resistance between the $77 and $80 per barrel marks. We let the structure of the market dictate our entries, and we let logic rather than adrenaline dictate our exits. While the retail crowd is hyper-focused on the sensationalism of the oil spike, the bond market has been quietly broadcasting a completely different, much more ominous signal. The bond market is the domain of sophisticated institutional capital, and it rarely lies. Recently, we have witnessed a profound drop in the 10-year yield. On the surface, you might attribute this solely to the broader economy slowing down, which is absolutely a contributing factor. But beneath the surface, there is a much darker mechanism at play. Smart money, individuals and institutions with vast resources and deep geopolitical connections knew this military conflict was imminent. Well before it hit the mainstream news cycle, they preemptively flooded their capital into the safety of US bonds. Despite all the ongoing, very valid debates regarding the sheer weight of US debt and the country's long-term ability to manage it, the undeniable reality remains that US bonds are still viewed as the ultimate global safe haven when the world catches fire. When panic strikes, institutional money flees the vulnerability of the stock market, which is poised to take a severe pounding, and shelters in the unyielding security of the bond market. The dropping yield was the smart money locking the doors before the storm arrived. This flight to safety is also going to violently disrupt the precious metals sector, but it requires a very nuanced, analytical approach to navigate properly. Gold, acting as the purest, most historically reliable safe haven asset on the planet, is almost guaranteed to gap up significantly in the overnight trading session as global fear peaks. Silver, however, presents a much trickier, dual-sided probability matrix. On one hand, silver possesses historical safe haven properties and will likely catch an initial sympathy bid, gapping up right alongside gold as panic takes hold. But on the other hand, silver is heavily reliant on industrial demand. The aggressive spike in oil prices acts as a massive tax on industrial production, which inevitably forces the broader economy to slow down. If factories are paying vastly more for energy, they produce less, which means they consume far less industrial silver. Therefore, while silver may enjoy a brief, fear-driven surge tomorrow, its medium-term trajectory is highly compromised by the economic drag of expensive energy. This is why we must dissect every asset class individually and avoid painting the entire market with a broad, emotionally driven brush. As we prepare to navigate the turbulence of the coming days, I want to leave you with a fundamental truth about long-term wealth building. Survival in this environment requires the complete and total elimination of ego. The financial media is designed to keep you in a perpetual state of heightened emotion, bouncing frantically between extreme greed and paralyzing fear. They want you to react to the news. Your job as a disciplined investor is to completely ignore the noise and relentlessly respect the structure of the market. We do not try to predict the exact moment a conflict will end, nor do we blindly guess where a market will bottom. We identify the ceilings, we identify the floors, and we wait patiently for the probabilities to align in our favor. Right now, the probabilities demand extreme caution. The S&P 500 is heavy, bounded by a 7,100 ceiling and threatening to fracture a critical 6,799 floor that leads down a dark stairwell towards 6,100. Oil is stretched to the absolute limit, hitting an $80 ceiling driven by temporary panic that is highly likely to evaporate by the midterms. Let the impatient traders gamble their capital on the overnight headlines. We will stand firm, preserve our ammunition, and execute our strategies only when the market comes to us. Stay calm, stay objective, and always honor the probabilities.